All right, and as expected, 405. If you refresh your screen, if you're on the website, net sales came in 1.078 billion. So they were down 110, about 110 million year over year. That's a pretty steep decline. Net sales dropping far further than expected. I'll pull up the sell side consensus. There are three analysts that still cover the company. The expected consensus revenue number was 1.18, so actual was 1.078. So a pretty big miss on sales, high single digit miss on sales, close to 10%. SG&A, which that's the cost item that the companies said they're very focused on taking costs out of that line. We had SG&A as a percent of sales of 27.5%, which just before we even talk about anything else, that's coming below gross margin. And I haven't yet gotten to gross margin, but historically, it sounds like they were likely negative in terms of operating margin because their gross margin is probably below that 27.5% of sales in the third quarter. Regardless, it was a meaningful improvement on a year-over-year basis as a percent of sales. So that's what you want to see if you're a GameStop bull. Um, Joe, when I get done reading through the press release, we can do the disclaimer, but
Yep.
I'm just reading off kind of the press release again for anyone who's joining. I'll go into kind of the backstory with Wook and GameStop and myself in a minute or two here, but I'm just reading through the just released numbers. We had a big miss on sales from a year-over-year basis. The uh, the decline was almost a 10% miss, high single digit percent miss versus both last year's result and what the sell side had for this year's result. SG&A improvements continued on a percent of sales basis, 520 bip improvement on percent of sales year over year. That's really solid. The question becomes how much more cost can they squeeze out? Just as I continue reading through this, just as a random anecdote, I saw a post. I followed the GameStop employee subreddit still. Just I've always been curious into the company, and I'll probably stay that way, even if I don't think it's an attractive investment opportunity. But I saw that they were going to be closing at least that individual employee's store in their province. They didn't explicitly say Canada. My assumption was Canada. They noted that that was the only store of the companies in their province being closed, but that there were other stores in the country being closed. So it could also be perhaps it's a province in Europe. They exited the Irish business earlier this year. I think they'll continue to reduce the store count, but at what rate, of course, becomes a big question. So let me continue. So the net loss, net bottom line after you factor in all costs and benefits, was 3.1 million for the period. Uh, so what's that? Not even a penny. There are 305 or so million shares out. So what's that? Not even a penny per share loss. So that net loss is improved meaningfully year over year. They had a 94.7 million loss last year, third quarter. So a third quarter, usually kind of second strongest quarter of the year for them as we come into the all important fourth quarter. Cash and equivalents, this is the cash and equivalents fueled really by the meme investors, if you will, with the two at the market offerings the company ran in 2021. So that's a little bit less than the sum of those proceeds. So they continue to have a nice cash pile, net cash position, in spite of the operating results being still not generating positive net income. Uh, so that's about it from a bullet point perspective that the company had to share. As I get into the actual numbers, it'll be lower on the release. I would expect the Q comes out in, I don't know, 5 to 20 minutes or so here. They're usually pretty prompt. So as the press release notes, the company will not be holding a conference call today. Additional information can be found in the company's Form 10Q. So, Joe, before I go any further, if you could kindly just read the disclaimer and kind of reintroduce us, and I'll then return back to the statement of operations and the stuff that maybe some people listening care about.
Yeah, we're going to get to this disclaimer really quick. Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action taken in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. I've also pinned in the nest a brief recap of the quarterly results. So if you want to see them written down, feel free to check that out.
Great. Thank you very much, Joe. Just looking at the stock, I know, most people don't care about me going through this boring operational stuff that I'm about to go through, but looking at the stock price action, it's very muted in after hours. So it's down less than 1% at present. This PR came out around 5 after. The stock traded in a fairly narrow range after hours, given its typical volatility. How about this? Before we dive into going through the results, let's kind of step back for a sec, do a brief round of intros, why we're hosting the call this afternoon, who we are hosting the call this afternoon. We have Tendy Barron joining Joe and myself on the panel today as well. So if he'd like to do a brief intro, he's welcome to. Tendy, if you'd like to kick that off, sir, please go ahead.
All right. Good evening, all. I'm the guy behind the Tenny Barron account, and I was asked to comment on GameStop's earnings tonight. So here we are. It was highly anticipated, and I've been following the company for a while. So yeah, I think I could share some comments here and there that could be interesting for some. So happy to be here. Thank you for having me.
Great. I think that very succinctly is how I would characterize, myself. Just to expound a little on that, I'm Rod Alzmann. You can see my personal handle is in the speaker panel, but I'm speaking from the Wook Capital account. Wook Capital Management is a private investment fund that I work for. John Kim founded and is our CIO. And John and I met both being investors in GameStop in 2020 and developed a friendship and relationship throughout the year. And I did with a lot of other investors. I don't think Tendy, I don't know that we met 2020, but a lot of folks through StockTwits, Twitter, the Roaring Kitty channel, of course, on YouTube. I joined that with Joe and with a handful of other folks in August 2020 through till when Keith Gill revealed himself to be DFV, Deep Fucking Value, the Redditor, and that on Christmas of 2020 he revealed that. So crazy to think that's all about 3 years ago. We played a small role, in participating in the shareholder activist that succeeded, who is now the chairman, or was the chairman, now the chief executive of GameStop. So I followed the company very closely for many years, been very interested in it for many years. And while, as we always say, while the share price is not the business, I've always been interested in following the business. And even though you'll hear me make comments that I think the share price is still rather disconnected from the business, I find it as a gamer, a lifelong gamer, and as someone whose life was positively affected by GameStop from an investment perspective, I'm always be interested in GameStop. So, Joe, you want to add your preamble?
Great, you summed it up pretty well. I met Rod originally on StockTwits. He'd been posting about GameStop quite a bit. This was around the end of 2020. I saw Rod posting on there quite a bit. He would used to look at the order numbers. So when GameStop's website would receive an order, the number was sequential according to the last order. So using that, he would ask people for their order numbers so he could try to model out how many sales GameStop was getting, which pretty lucrative approach. And I found that to be compelling. I also saw him in the Roaring Kitty YouTube streams all the time. So I think I DM'd him on Twitter one day and was like, hey, this GME DD idea is pretty novel, but I think it could use a little work. So together we revamped it and put this project out. And I mean, it's been two years now since it was started. So it's been quite the project. And I'm happy to be here. I had the blessed opportunity to conduct an interview with the chairman, Ryan Cohen, back in November of last year. Still available on YouTube if you haven't seen it. And yeah, great guy. Nothing but good things to say about him. So yeah, still follow the company personally, but don't publish any more subsequent research on it.
All right, very good. Let's look at the numbers then. So I mentioned at the onset, and so the 8K is out. I didn't see anything else in the 8K that wasn't just on the press release itself. I don't see the 10Q. So while the company points to the 10Q for additional detail, we'll get that in about 15 minutes. And just like order events this afternoon, anyone who wants to chime in, uh, please feel free to request to be a speaker. But we're gonna probably walk through maybe the financial statements at least from kind of top to bottom before we do that. I know a lot of people would rather talk about the stock price or the technicals or whatever, but we can do that at the end or later on in the chat. Expect, we start with 15 minutes in. We just not even 12 minutes in. So we'll probably run this till 6 p.m. Eastern time if we have enough to talk about. We typically host on the GME DD account the market open mic, which, Joe, if you want to make the GME DD account a speaker, a request, I can add it to the panel to get more reach if you'd like. But yeah, so we'll go for a couple hours, an hour and a half or so here. But anyways, so yeah, net sales, top line down, 900 plus million year over year. It's a big miss on that, but it's, to me, the top line isn't like if there's an interesting fundamental oriented story, it'll be how they can improve both gross margin and also reduce. We talked about the SG&A as a percent of sales being down over 500 bips year over year. That's stuff that because I see them. I would think most people would agree that they remain a secularly challenged. The top line number remains secularly challenged from the ongoing digitization of games for console. So if we keep seeing them close stores, I don't know that top line is going to start growing anytime soon. Is kind of my point. So I think that they need to make improvements below that top line. So the first good thing though is when you move from net sales, you get below cost of sales. We see even though the top line dropped, 9-ish% year over year, gross profit only declined by 10 million. So because their gross profit improved sequentially or year over year, that means that gross profit only deteriorated by 10 million. And then you had that huge improvement in SG&A, which is we're only at a $15 million operating loss, which is still not good and not in line with what the business is valued at today. But a $15 million operating loss is meaningfully improved from a $96.3 million operating loss in the third quarter of 22. They do generate, because of that cash pile that we discussed, that they raised meaningful interest income, just shy of 13 million in the quarter. So from operating, you're getting a nice benefit on interest income. They have some here in other loss. Again, without the Q, we don't know what that is. It could have to do with some cost related to severance that they've talked about. When maybe they're going to take that in this quarter from some of Ireland closure costs. I don't know. We'll see when we see the Q. But
the 10Q is out.
Mm-hmm. Oh, it's out. Great. Okay, I'll pull that up too. But yeah, so walking through, just to kind of get through the income statement, walking from operating, you get the interest benefit and then that other loss. Before tax, you're at a $4 million loss. You get an income tax benefit on that, so your net is around 3, which it's a 1 penny loss per share. So the bottom line result is actually a beat relative to what was expected from the analysts. The expected loss was 8 or rather 9 on a GAAP basis, 8, I guess, adjusted consensus. So the fact that they only lost a penny, it just shows the power of the SG&A takeout. Yeah, and the interest. Sorry.
Actually, I would argue that it shows the power of the net income, of the interest income they make from their cash pile. So if we look just at the business alone, we see revenue falling quarter over quarter, or at least year over year, and the business itself, the operation, it's losing money still. Like it's the losses are decreasing, mostly driven
Yep.
by cuts in SG&A, but the revenue decline. I'd like to see where it comes from, like if there's any particular segment that was hit harder than the other ones. So I'm gonna look for that in the 10Q.
It's not loading for me. Has it loaded for you? I'm getting that this format is in process of being
Yeah,
created.
yeah. So the PDF, it takes longer to generate. So what I'm going with is the HTML version.
Yep, the HTML works currently. I'll send a link in the Discord.
Okay, you guys are fancy. All right, I have it up. So, the good thing is, first thing that's good is continued very minimal ongoing dilution. Compared to other quote unquote meme stocks, at least in my view, this one is the best in class on that front. I think sequentially we're talking about maybe 100 or 200,000 shares, so very minimal um, dilution from paying their employees through restricted stock, etc. So okay, I don't know where we should if we should go back and just talk through any of the other statements. I'm in the queue, just see if they call anything out.
So in regards to the dilution, the shares outstanding only increased by 1 million in a year
Yep,
on a 300 million plus total shares outstanding. So it's very minimal dilution.
yep. I'm just scrolling through the 10Q to see if there's anything interesting that they're calling out. They're just reiterating the commitment to the sale of the European properties, which I
Yeah,
believe is the
I'm
Milan warehouse.
I'm looking at the revenue segments right now. It looks like the cuts in revenue were pretty uh, divided. Like it's not in one segment particularly.
Yep. Well, look, so this is
So it's
something that
probably store closures.
Joe and I and my team, we were kind of spending time on this week, is how difficult it is because of the limited amount of disclosure this company provides to really like get into those three categories they report on, which you noted they're all three of them, which is hardware and accessories, software, and collectibles. Now, the thing is that there's pre-owned sprinkled into those categories. However, we don't really know the mix of pre-owned within that, at least not directly. There's a disclosure the company provides on the 10K. They provide a disclosure on how much physical software they've in their sustainability report. They provide a disclosure there, but I guess my point there is that pre-owned software's gross margins that they stopped disclosing after 2018 were 40 mid 40%, low 40% gross margin. Compare that pre-owned to a new software sale, which is around, let's call it 20% gross margin. That's where the pre-owned piece is what a lot of people I think miss with GameStop, is understanding how relevant that is to their business and to the kind of the negative network effect of physical becoming less and less common. But yeah, again, going back to the lines, collectibles was down again 20 million year over year, high single digit percent revenue decline. Collectible is another higher gross margin category. The gross margins on those are somewhere around 30, low 30s% gross margin, at least when they used to, disclose that. But seeing that decline is not good, because even the last, go back to 21, 22, that was kind of a bullish category. The expectation was that collectibles could grow to become $1 billion revenue business, and unfortunately, it's taken a step back this year.
Yeah, the business is mostly being held up by hardware and accessories,
And hardware and
and
accessories, the
the
tough.
other two segments, software and collectibles, are just they're not growing year over year.
Yep. And within, to go back to that kind of point I'm making about the lack of granularity in what they currently disclose. They used to, and this is two management teams ago that made the change. They used to disclose the pre-owned, the accessories, the collectibles, the new hardware, the new software gross margins. So when you think about hardware, when you think about them selling a Sony PlayStation 5 or Xbox Series X or Nintendo Switch, like back when they used to disclose that, their gross margin on hardware, on new hardware, is in the single digits. It's in the high single digits at best. So they're making very little money when they sell you that new console. They're making their money on selling you some accessories where the gross margins are north of 30% and hoping you pick up some knickknacks and collectibles and some pre-owned video games while you're in there, right?
Yeah, so I think you raised a good point then, because if we're looking at revenue versus cost of goods sold, then we see that gross profit percentage is increasing, right? So,
Yeah.
but if we look at the revenue segments, then we see like a similar downtrend, at least for this
And
quarter
that goes
in
back
all
to
segments. So I'm just
exactly.
wondering, like then what are they selling that nets them more margin, more gross profit margin?
So it's going to be some within just sales mix, but within how they sell, they talked about, I think in last full year annual report, they talked about less added freight cost, right? Most retailers paying some exorbitant freight rates in late 21 for much of early 22, uh, as well as for them in-store sales mix going back up because the cost of fulfilling e-commerce orders for them is higher. So they have a higher gross margin on in-store sales. Back when the company used to have conference calls, former CFO Rob Lloyd had made a remark, I believe. Again, I've followed this company too many damn years, along the lines of the attach rate is materially higher for collectibles in store versus online. And going back to the comment I made that collectibles gross margins are in the low 30s, that's accretive, right? Relative to the mid 20s, they came in at 26 this quarter. So there's moving parts around mix, around where some alleviation of cost in that COGS line from freight and from credit card processing fees and the like, I'm sure. But I mean, going back to the high level, at some point you need revenue to stop bleeding. There's only so much gross margin improvement you can realize and cost you can cut out. So I think while if you're a GameStop bull, you're relatively happy to see those operational improvements with improving margins as they flow through from gross and operating, negative operating margin narrowing. Uh, you still, though, you still don't have a solution to revenue.
Yeah, I mean that's kind of what we're seeing here. Like the bottom line improvement is mostly driven by SG&A cuts, and it has been
And
for
interest
the last
expense,
few
as you noted.
quarters.
Yep. Or
And
interest
yeah,
income, excuse me.
yeah, exactly. So like if you would take away the interest income, like bottom line would be negative, and I mean the loss is decreasing, so I think that's a good sign. Like they have like GameStop is fortunate to have this big cash pile, and it gives them such a big runway, at least with the current uh, cash burn.
Yeah.
So I mean,
Well, it gets back
the
to how I've heard some people characterize it, right? A lot, obviously, the high mix of retail investor base and the general enthusiasm behind the CEO. That people have bid this up. Like when we try to analyze this on an operating basis, and even if we assume operating improvements, it's hard to justify the valuation. There's still a very large Ryan Cohen SPAC-esque premium baked into this, but because it's literally a $1 billion and change of cash that has an operating business that's bleeding less, albeit not again generating anything I guess to write home about from an operating result. I guess that's kind of how I've heard some people characterize it, which I don't. Yeah.
I'm just wondering on your thoughts here. Like you were mentioning, like digital versus in-store revenue,
Right.
like, and you were saying like the store revenue has a higher margin. I'm
Yeah.
wondering like how much of that is also attributable to the way you put it into accounting, right? Like freight costs might be uh, within cost of goods sold, whereas like the rent and the leases of your stores and the cost for your employees, that might be under SG&A, right? So
That's true.
naturally, that would give a higher gross margin towards in-store sales.
That's
Whereas
true. And
if you
the
would look at the
challenge is that the
bottom
company
line,
doesn't
right?
give us much, further breakout to let like really help us as investors and observers understand, because they had told us going back to pre. Um, this is I think Sherman's management team actually, and they talked about this, but they used to disclose, or that they shared this disclosure that at the time 95% plus of their global store base was uh, four-wall EBITDA. As thinking of four-wall EBITDA as that store's costs, not providing an allocation to all your corporate overheads, but that store's cost to kind of get a more clean view of what I think you're getting at. So,
Mm-hmm.
so most of their stores, if you look at them in isolation, we're doing well, and that's where what they saw they could do, and strategy that the previous management team had undertaken was to de-densify, to close stores that, even though most of them were, let's call it positive EBITDA, or close to it, uh, they could transfer 30-40%, was a number they shared, of sales from a closed store to adjacent stores, or to the .com, and therefore they could generate incremental EBITDA savings through that. So that I guess what I would expect to see here is them continue to whittle down some of their underperforming stores. Right, they just, if revenue is going to keep declining, I would expect to see store counts keep declining, somewhat in line with that. But they just don't say anything about what they're going to do.
Yeah. I don't think we can get the store count in the quarterly report, right? We have to wait for next quarter. Yeah,
I
I don't think it's
don't
in this
know.
report.
No, they might have at one point, but they certainly don't. They now say thousands of stores and e-commerce platforms, so I don't see a store count. We'll get that
Well,
early next year when we get the fourth quarter result.
so here's what they say though: the decline in SG&A expenses for the 3 months compared to prior year is primarily attributable to a reduction in labor-related consulting service costs, marketing costs, um, a marketing cost of 70 million, driven by our continued focus on cost reduction efforts, and store-related costs decreased 8.5 million in the current year in connection with store closures, primarily in our European segment. So they did have like whatever cost they had for primarily for the store closures, like they had more of it last year, so that contributes to a decrease in SG&A.
Yep. I do see a recent developments in the queue as I'm getting through the MD&A. They talked about yesterday, the board approved the investment policy. The board has delegated authority to manage the company's portfolio of securities investments to the company's chairman of the board of directors and chief executive officer, Ryan Cohen, together with such assistants and management committees he may engage. The company's investments will be made in accordance with the guidelines set forth in the investment policy. The board may also approve non-conforming investments and or in consultation with the chief executive officer, modify the investment policy from time to time. Mr. Cohen directs the investment activity of the company in public and private markets pursuant to authority granted by the board of directors. Depending on certain market conditions and various risk factors, Mr. Cohen, in his personal capacity or through affiliated investment vehicles, may at times invest in the same companies in which the company invests. Such investments align the interests of the company with the interests of related parties because it places the personal resources of Mr. Cohen at risk in substantially the same manner as the company in connection with investment decisions made on behalf of the company. Okay, I guess that's curious.
That's interesting.
So, like, thinking about the prospective firepower that Ryan Cohen / RC Ventures / GameStop Corporation, the public company, they have a bigger, I guess, wallet potentially for these non-conforming investments that they may pursue. That is different. I'm not sure how many public companies have some structure like this.
Almost sounds like he has the 1 billion on his hands, and he can do with it what he wants.
Yeah,
Yeah.
the 1 billion is Cohen's personal piggy bank. He can just make an investment.
That's crazy,
acquire
dude.
something.
That's a crazy setup. Like,
he is the largest shareholder, so as the second sentence notes, the investment interests align the interests of the company with the interests of the related parties.
Well, that's majorly true.
I think if you're an investor, if you're a long, and your thesis hinges on a perception of Ryan Cohen's prowess, then you're probably happy to see that in recent developments. Just coming back to the stock, it's still relatively flat, up less than 1% after hours. Full disclosure, I made a trade in my personal account. I wrote a short strangle. I wrote the $12 put and $20 call that expires on Friday for 63-cent credit. I wrote a handful of them, so hopefully I got some free dinner money if it stays flat.
Oh, it looks like it so far. So I'm also a small detail here for the listeners that care about it. I looked up the DRS numbers in the report, and it looks like it's flat quarter over quarter. So just detail for the people that were interested in it.
Yeah,
75.4 million. Oh, what? Was that too early with this?
No, you're good. Yeah, exactly. So 75.4 million. Yep.
Which is still
a
crazy big percentage of the total shares outstanding, over 25%. So that's still impressive. But it does look like there's no growth there anymore.
Yeah. Well, on net now, and this was actually, I was curious to see what would happen because of the share price decline, right? You had a pretty meaningful decline in the price during this quarter. So this is when did they report the last quarter? September?
It's desirable for shareholders because your buying power increases, right? You can get more shares for the same amount of dollars you have.
So you're right, but let's get back then to what we were saying about, okay, so what are you buying? You're buying GameStop Corporation, which has some cash on its balance sheet. It has an operating business that's treading water. Maybe it's going to improve sequentially somewhat on an operating basis and get above water. Okay, what's the right multiple to pay for this entity? For you have this operating business that, let's be honest, from what we've seen this console cycle to date, the mix shift toward digital has accelerated, and the console makers seem quite content with shifting toward digital only or oriented consoles, as the mid-generation updates shown from PlayStation and Microsoft. Now, we'll get the new Switch next year, which will be interesting because that's still close to 50-50. It's more than 50% digital, but Nintendo does provide on a quarterly basis the breakout of the physical and digital software mix. So Switch is very important. Even though GameStop doesn't disclose who its primary vendors are anymore. The latest year that they did, 2020, Nintendo was its largest vendor. As a percent of sales, Nintendo was almost a third of GameStop's sales. So when you add Microsoft, Sony, and Nintendo, the three console makers, that's above, or it was above 60% of GameStop's vendor base in the last year that they disclosed that. So they're very beholden to consoles and to the console cycle still. Seeing the collectibles business stalling out is not good, and seeing the declines is not good. If you're along, and where are the incremental cash flows coming from, to justify, right? If you lost a penny, let's say on a full year basis that they make 10 cents per share, which I don't have them getting there for a few years. But like, what's the right price to earnings on 10 cents per share? It's the stock is very disconnected still, I think, from underlying fundamentals, and it's curious. It's just a curiosity to me.
I think that that's always going to be like a reason for debate, right? A reason for discussion, because there's different perspectives on that. But if we look at the balance sheet, what you for sure are buying is a company with a big pile of cash. That's one of the main bull arguments I keep seeing everywhere. And you can account for that in the valuation, right? You can just
Exactly.
subtract the cash pile, and like divide it per share, and then subtract that from the share price. So like what's that, like $3.5 $4 a share? That's
So
the cash on hand per share,
cash and equivalents. You've got to also add marketable securities, which they've got
right?
about 300 million in. I know they've got, like, let's call it 40 million. I don't know what the exact number now is on those loans, the low interest French loans. So then what I'm getting at is net cash should be about 1.17, and there's 305, right? So you're talking about $3.83 per share in
Yeah.
net cash, give or take. So it's trading at, call it 14 and change. So you've got more than $10 per share in operational value.
Yeah.
Going back to my 10 cent per share, that'd be 100 times earnings. That doesn't sound right.
I mean, so it basically means that for the operation, you're basically paying 10 $11 per
Yeah.
share right now.
Yeah.
And so what I want to see, or what GME bulls want to see here, is an increase in revenue, like, and an increase in the bottom line, of course. And then like right now, Cohen is making meaningful cuts in SG&A, but if revenue keeps dropping more, like, then it's at some point you cannot keep cutting SG&A anymore, right? It's, you can cut stores, but then that's gonna decrease revenue, which means you further have to cut SG&A, like, or cut stores, and then it
Well,
becomes like
that's
a
where the
vicious
math.
circle, right? And that's what I hope is
Yes,
not gonna
yes, to an
happen, of
extent, it
course.
can be a vicious circle, but that's where I was sharing the data point around how much of that closed store sales can they transfer, to a nearby store, or to retain in their, .com ecosystem.
Right.
Because if they can keep cutting out layers of, management, maybe there's some, but I guess a concern of mine is something that I see here that I worry about from a, if I'm trying to wear the perspective of an investor looking long term, is let's look at capex. Let's look at capital expenditure. This company is spending very, very little. Their cash flow statement they give us, I hate this. They give you the, year to date through 9 months, so you'd have to go look at the previous one to know what the quarterly capex was. But
Oh yeah,
regardless,
I hate that as well. It's
year
so
to date
annoying.
capex exactly is 27.2. So let's just say full year run rate like 36, 37, maybe a little more, right, with the 4Q skew. Let's call it 40. 40 million in capex. You're talking about a company generating still, what, north of 5.5, less than 6 billion, but over 5.5 billion run rate revenue. I don't know. It would make sense to me that capex is being starved if a lot of these leases are going to be kind of run off. So I am definitely curious, how much more store closures do we see? from reading the tea leaves of what employees have been talking about, right? We've got the GameStop Pro change where they've changed the pricing from 15 a year to 25. They've kind of nerfed some of the benefits. We talked about they nerfed some employee benefits, which was like, I think 401k matches, some insurance and healthcare related benefits. So like those all will incrementally cut some SG&A out and cut some spending if we're going to see capex start. But I just wonder what is like a sustainable level of capex, and I wonder if that level that they're at is too low. It feels that way to me.
I mean, maybe they are also starving the capital expenditures because we're in a high rate environment, and they are currently using this cash pile to just generate interest income. So yeah, but I mean, at some point you have to, right? Like, so I guess that's the point you're trying to make. Like, for how long can they starve this capex? Like, can they delay it, or like, or like even avoid it? Right? If you don't have to remodel stores if you're going to close them in a year, but if you're going to keep them,
Right.
then you have to at some point. So I think, I mean, in terms of revenue, like I'm just thinking, like, what if it's not related to store closures? Like, what if it's like maybe it's related to a product mix or something, right? Like they're getting rid
So
of
I do agree
certain.
with the notion that sales, like if we just were to look at the math of take revenue and divide by total stores, that number should keep going up, and I think it will. That sales per store that they have will keep rising, only because that doesn't capture the e-commerce, which I think will keep growing. But I mean, they had almost 6,000 stores in 2018, for example, and we were at the latest K at 4,400 stores. That's global. In the U.S. alone, there were still just shy of 3,000 stores. And when you look at certain cities in the United States, you can see a half dozen or more GameStops. And the question becomes to me, like, what is the consumer's willingness to, drive, 10 an incremental 5-10 minutes to go to this GameStop versus buying it online at GameStop or at another retailer. The store location base, and I know Tendi, you're joining from the continent.
Mhm.
It's a different layout here than it is over there in the U.S. It's mostly these little strip malls. It's night. Last they disclosed was in like 2018 under Mike Mahler, I think, a very short-lived CEO. He talked about the difference between the U.S., which is like 90% strip mall versus kind of your traditional big mall, whereas in Europe it's the opposite. It's mostly in the shopping malls in Europe.
Yeah, well, I mean, didn't we see some store closures in Europe last year? I haven't seen any messages on it recently,
They
but I
closed
think they were
Ireland
closing in
this year
Austria
as
and
well.
Ireland.
Yeah.
Well, maybe not all stores in Austria, but I thought I saw something about it. But yeah, I don't know. I don't know how much of that is still ongoing. So that's why I bring up the argument. Like maybe it's a product mix thing, like where they got rid of certain, like product
Yeah,
lines or.
in the company's disclosures under net sales, they tell us that the increase in net sales, so they had an improvement in Europe due to decreased supply constraints. The overall decline in net sales was primarily due to the hardware and accessories, but as we kind of noted, it was across the board with declines in collectibles and also new software. Um, they also talked about gross profit. So we had talked about how there was, the 150 basis point sequential or year over year improvement in gross profit margin, and that was I mentioned the decrease in freight expenses. So that was what they said it was,
Mhm.
resulting from added cost optimizations. So we don't really have much more detail on what those added cost optimizations are, but yeah.
Yeah, it's unfortunate. Like this is the area where an earnings call would have been hugely helpful, and let's talk about that because so here, from my perspective, I think it's important that a CEO addresses his shareholders, and I think it's frustrating for me, at least personally, to see a CEO not do that. Um, and like historically, he has always said like I don't want to telegraph my strategy
Right.
to the competitors, right? Which I think it's a valid point, but it only goes so far, really. You can still hold a call, give some clarity to your towards your shareholders, um, without like giving everything away, right?
You
I
know,
think
I
it's a
guess
fine line. You don't have
I,
to hype your shareholders. That's also not what I'm saying, but it's just like,
I'll give you devil's advocate of what I think he would kind of come off and say is that, well, look, why am I going to waste, why am I going to invest all this time? And I say this having professionally seen firsthand. I worked at Ryder in the corporate strategy team, which supported the investor relations function closely. So I got to, help on creating some of these decks. But when you think about how many hours of prep work go into preparing for an earnings call, for the Q&A, for all of the material. I mean, you're talking about a lot of money and a lot of cost. And if his, I think, not hypothesis, his, the way he operates simply is that he doesn't think those costs are add enough value, and that if serious investors want to follow along with what's happening, the 10Q, the 10K, that'll have an adequate disclosure, which I can appreciate that perspective.
mhm.
There's a lot of fluff in these different. The reality that a lot of an investor relations function is marketing. I mean, think about how many people have lost a lot of money from some of these investor relations teams and presentations that have been, poor representations of the outlook for the business, et cetera. So, I mean, look, the letter that leaked or that he sent to the whole kind of staff in house, I think that's how he feels, and it's a reality. This is a challenged business. They've made cost improvements. They're trying to get it to survive, and to survive would be to win. But the stock is priced for thriving, and I don't think that there's a great outcome from a return on investment perspective, given where the starting point as of today stands, given the underlying business, which some people will call me a bear for that, which I mean, yeah, I'm bearish on the stock price, but I do think that they can survive. I hope they do.
Unequivocally, the most interesting thing today was the new investment policy. So I tweeted out a screenshot of it in case anyone doesn't have the 10Q pulled up, and that tweet is pinned in the nest. Essentially, just saying that Cohen now directs the investment activity of the company in public and private markets, pretty much has full control of what GameStop puts their 1.2 billion to use with. So very interesting. I think ever since Cohen first got involved, there's been people expecting some sort of acquisitions on the part of GameStop. So maybe that's not what we're going to see.
I think that he's going to be opportunistic. I don't think there's a huge rush. I think when I think about reading about folks who know a hell of a lot more than me on credit markets, and how many of them are you know, of a view that the worst is yet to come from corporate defaults and distress and the like. You saw how little, Bed Bath's IP went for in their Chapter 11 sales process, right? You can opportunistically buy valuable intellectual property or other assets out of a distressed sale. When you have forced sellers, that's when you want to be a buyer. And I think what's clear to me is that he's not going to rush in. The company's not done much with that cash pile in the time it's had it. I don't think it feels a ton of urgency to, and I think if it uses it, it will be opportunistically. So, what does that mean? That means at some point, some deal presents itself, and who knows what that's going to look like. I keep saying the adjacencies that I see for GameStop are stuff around like authentication, whether that's authentication for like collectible cards or even introduce footwear. I don't know. Like the fact that you have that muscle, that you have a refurbishment process. I mean, granted, it's oriented around the legacy business, but lean into that, lean into the buy sell trade model, because that's where the margins, are going to be, other than digital. I mean, and we can all say you want, digital margins, but the reality is that their digital forays haven't generated any material revenues, yet. And really, the big digital margin expansion is from pricing Pro at 25 instead of 15, because as we talked about last time, based on them having, just shy of 6 million paying Pro members, even if you assume that churn, jumps up and they lose 30% of them, that would actually kind of cover this quarter's, gross profit gap, right? That would have been an incremental, 15 million-ish in annual gross profit. So that would have plugged this quarter's gap with those digital revenues, if you will. But anyways, attendees, it's been good going back and forth with you over this. If anyone's listening, wants to ask any questions, please feel free to request. We'll bring you up. We're about an hour in. So, I mean, looking at the 10Q, I don't really see much else that's that interesting, other than what we already talked about.
Yeah, maybe when some people some other guest speakers come up, we can discuss something else in the meantime. So the DRS numbers, I know for a fact that there's a lot of shareholders that were eagerly awaiting the numbers and hoping to see an increase in the numbers, and unfortunately that didn't materialize. So I'm just wondering on your thoughts, like why that might be the case. Like, could it be like like external factors, like macro factors, like the economic environment is much more difficult nowadays.
I just think the super
What are your
stonk
thoughts on that?
movement slowed down. If you go check out the subreddit, I mean, there's less posts than ever on there. There's less engagement, less comments. I'm sure a lot of people that bought into the DRS movement a year or two ago now. It's been a long time since that approach was thought up, and people have moved on. People have not really stayed as engaged and as before.
Hashtag never leaving, Joe.
Hey, they'll say that, but they'll slowly start spending less and less time on there, start writing off the investment, and not being as engaged. I think it's just not as people lost some hope in not doing anything or accomplishing anything.
Yeah, I hear that argument. To be fair, in defense of the current shareholders, like while there might be some people leaving, it's not a net decline, right? It's just a net zero. It looks like. So like whatever growth is there, it's being canceled out by like people that are dealing with tougher environments or have lost hope or anything. Like, who knows, right? You don't see these people online. They're not vocal.
I got a question for Rod, if that's cool.
Go ahead.
Awesome. This is completely off topic, so I apologize for that. A few weeks back, I came into one of these, and you were talking about BTI, and I noticed they had a pretty sharp drop, and I was wondering if you could explain that. I super quickly skimmed it, but something about getting fined for something, I think.
No, they released so they're a British-based company. They provide 2 updates a year as opposed to quarterly. So in December, they do what they call a pre-close update, and then in February, we'll get the full year result. But in the pre-close update that came out overnight or morning in the UK today, they disclosed that they were going to take a large impairment on their purchase of chiefly the Reynolds American business that they'd bought 6 years ago. So it's a big non-cash impairment. So that's the big headline. I think it's like $31 billion in dollars. They talked about revenue and operating income being up for 24 and 25, low single digit, and then returning to mid single digit in 26. So the stock sold off a lot, as you noted. To me, I mean, the write down, I mean, it's non-cash. It doesn't affect the future ability of the business to generate the cash flows. And I think it was overdone. In my personal account, I added several hundred shares today. I added 100 basis points of exposure. So it remains my largest personal holding for what it's worth. All right. So Eric, you'd come up. Did you want to have a question on GameStop or comment? And bring Josh up as well.
Yeah, sure. Thanks for the space and thanks for hosting. On the topic of DRS, I'm actually one of these guys who, I don't spend time on Reddit. I have a life. Just kidding. I do have to me, a significant portion of my portfolio DRS, and just go on with my day-to-day life. And sure, it trickles up or whatever a little bit once in a while, but do you guys want to speculate or lend any credence to this sort of semi-conspiracy theory, or maybe it's a whole conspiracy theory, that perhaps there's some sort of message or position from regulators that GME should not be or has a specific restriction in place on how they report DRS shares, as you guys have seen and probably talked about already, hasn't really moved quarter over quarter. Do you think there's any sort of credence to this idea that maybe regulator wants to nip in the bud any sort of meme mania of, oh, okay, now DRS is the next big thing. There's not going to be any other shares for Seed and Co. There's going to be a drop in liquidity. You're going to have this great crazy spike. I'm just curious what your guys' thought is on that. I mean, it sounds crazy to me, but I think I know, just from a personal life, I know enough to know that sometimes things behind the scenes can be crazy. And we are never going to get anything from Cohen on this. I think we all know that. But just curious what your thoughts are on that. And you can dismiss it as nonsense, but love to hear the take. Thanks.
Well, thanks for the question, Eric. Do you, Joe, Tendy, do you want to take it first? Otherwise,
can I respond to that? So, I think companies should always report the facts as they are, and if there's a problem with the facts, like for example, like if more than the total shares outstanding were to be DRS'd, I think there would be like subsequent events after that. I've seen also like some speculation like in the last 3 quarters on why DRS numbers were not as high as previously expected. And like personally, I don't believe any of that. I think, as I've said before, I think we're living in tougher times, and I think like especially since it's been a long time that people have been holding. So I think that there are shareholders who have made the decision to sell, but I don't know, like it's the only thing we know for sure is that growth is not going up as high, and it's not growing as fast anymore as it used to be. But no, I really don't buy into the speculation part, and like even if you were to buy into that speculation, like why would the threshold be here at 25%? Like why not higher, right?
So I think it gets back to the word you just used. It's completely speculation. If the mix of shareholders that have opted to directly register their shares is in your head a material piece of information to what you believe is your thesis, it's not an investment. You're hoping that you're hoping you can sell this to someone at a higher price because of some sort of mechanic that you maybe think you've fully understood. I don't think any of us fully understand some of the mechanics that caused the volatility in the stock in Jan 21 and for much of 21. But I can only say that for me, at least, like the notion that some forced action would obligate some entities to buy the stock for me at a higher price, that never came into my mind as anything more than, that would be at best a tertiary consideration, right? The level of short interest in a security, the mix of people who'd be forced to buy to close, or who might find themselves margin called. Quote unquote, the shorts are not a monolith. There's, as the stock goes up, there might be people who are on the sidelines who decide they want to get in, and they're gonna, be the next in line. So, I think people get too overly obsessed of this kind of us versus them, we the shareholders versus they the evil, short sellers. And that's why my focus is really around what is this worth, trying to come at it from a fundamentals perspective while fully appreciating that the market is not solely priced off of these fundamentals. I don't believe there's any massive hidden short interest in the stock. I mean, and frankly, even if that were true, so what is my question? It wouldn't change how I invested in the business, would it? So, I get there's a lot of people who think that they were robbed because of how their margin accounts, were treated in Jan 21. But my view is that there's a broad-based misunderstanding about how kind of securities markets work, and people aren't. If that's a focus, you're not making an investment. You're just making a speculation, which you have every right to do.
Only
Hey
point
guys,
I'll
can you hear me?
add. Oh, 1 second, Josh. Just going to add that reducing liquidity in a stock increases the volatility both ways. So if you directly register your shares, you're contributing to more violent movements up and down. So it's just something to think about. I see people think that reducing the shares out there is just going to help their stock go up, but it's also going to make it more manipulatable down as well. So something to consider. But yeah, go ahead, Josh.
Hey, thanks, Joe. To the recent development with Ryan Cohen being delegated to having authority to manage the investments on behalf of the company, do you think that would just be boilerplate language, comparing it to when they fired Furlong as CEO and said that Ryan Cohen was then responsible for capital allocation back in June? Hello?
Yeah, I don't read it as that boilerplate. Sorry,
I guess is there a big difference between when they talked about him being able to be in charge of capital allocation in June? Is there a big difference from that to this recent post?
Well, let's see. I actually didn't see if this investment policy was disclosed by them in detail. I don't see an exhibit for it, but they refer to it. I guess the difference to me would mean that, as I read it, because Mr. Cohen has the full delegation, and that the board may also approve non-conforming investments, that he has the flexibility to lean on his personal family office, the RC Ventures balance sheet, in conjunction with GameStop's, to potentially do a bigger deal.
That's interesting.
That's my take, and that's why I find it interesting. But I could be off.
Well, thank you for the response. I really appreciate it.
You're welcome.
It makes sense too, because Rod, we always talk about how Tesla investors often consider their investment is one in Musk and not just in Tesla. When in reality, it is just an investment in the automobile manufacturer. It's kind of different here. It seems like now an investment in GameStop is more an investment in Cohen than it was prior to this new investment policy.
Yeah, I would agree with that. But it gets back to how much is the bet on Cohen? Like, what you're paying a lot of money for the option to be involved with what comes next. No matter about any way you slice it.
$11 for Cohen.
Well, it's not
$11 per
$11.
share for Cohen.
It's over $3 billion is the implied value, right? Like, I mean, we're talking about what is the operation worth, right? We talked about, okay, so I don't think the operation's worth more than a couple of bucks. If you do a DCF,
I'm just gonna be advocate of the devil here. Like another
Sure.
bull argument I've seen is an acquisition. Like the company has such a big cash pile that in this higher rate environment they would be able to pick up a company for cheap, and it would be like beneficial, and that would in turn like increase the actual fundamental valuation of the company, not what the market is pricing it at, regardless of what the market is pricing it at.
I guess the issue is that the market's already baking in a wildly successful acquisition that delivers billions of dollars in value. No, that's kind of what I'm getting at by breaking down the amount of cash they have, what I think the operation is worth, and then what I guess is now more clearly, truly a bet on a Ryan Cohen transaction, a value creating transaction. Most M&A is not value accretive; it's value destructive. As come back to the question about British American Tobacco, they overpaid for Reynolds American, simple as that. And now they take the impairment. But yeah, I mean, you're paying too much, is how I see it. You're paying too much for something that may happen. Like what do you plug in? A 50% chance of a transaction that creates how much in value? Like, how do you justify it? And I guess reality is this can continue. We mentioned some people maybe are running out of patience, if you will, because their thesis is something pertaining to the notion that there's a large short interest rather than the notion that Ryan Cohen will deliver incredible value-added M&A. Like, it's still, to me, it's hard for me to square the valuation with what we're looking at.
You might have a better view on this. Like, what are competitors to GameStop where we could see like, hey, we could compare like a PE ratio. Like it's very basic, but I think competitors are like 10,
Best Buy.
10, 11 PE, right? So at current
right.
at current market cap, what's that?
No, you can't. We can't use anything current because they're not really making any money. I mean, if we assume, let's assume, in the model I have, which I'll have to make an update to based on today.
They would have to make like 400 million per quarter, per year.
I have them at less than 100 million EBITDA in 2027, which even giving them a generous exit multiple of 10 times, which I think is rich. And if you looked at Best Buy, sorry, BBY, as a decent comp, that 10x is probably rich, but that has the thing worth $5.50 per share right now, and that's at what I think is a richer exit multiple. Granted, I don't have wonderful results in my forecast period, so maybe that's too bearish, but I'm so far from what the market has it priced at. But I think it does get back to Joe's point that it is in fact now a relatively clear or more clear linear bet on Ryan Cohen is the largest investor. Ryan Cohen's the chairman and CEO, and he controls the company's investment process. And there could be some unorthodox transactions given the capital that he has on his family office's balance sheet plus the company's, right? So that's what you're making a big bet on. You're paying a hefty premium for the assumption that the bet is highly accretive. That's kind of, I guess, how I would characterize how it looks today. But Chris, you came up. Did you want to chime in on that, or?
Yeah, I've been listening to this space for some time, but I didn't really have a chance to look at the GME earnings announcement. So forgive me if I'm ignorant of some details, but I'm kind of curious. Like now that I don't like to talk about it, but like crypto, like Bitcoin has gone up a lot in the last couple weeks, and it seems like there's a huge surge in like FOMO and interest in crypto now. When like a year ago, right, there was the SBF thing, and it seemed like it was kind of dying. And I'm wondering, like or maybe during the earnings call will they talk about it, the player.gamestop.com and their NFT stuff.
There's no call.
Oh, there's no call. Okay, that's great then.
No, they don't say anything about it in the queue.
Okay.
We talked about the results. I mean, Chris, the results are basically a big miss on the top line, but GM improved 150 bips year over year, and SG&A improved 500 bips plus year over year. So even though there was a big top line miss, the net with the benefit of their interest income from that cash pile, they only lost a penny versus 8 cents was expected. So better on the bottom line, but again, it's still an operating loss. We'll get the fourth quarter, and on a full year basis, they're probably going to be generating positive EBITDA. But
so no word on the NFT stuff.
I didn't see anything in the queue. Anybody else?
I didn't look for it, but in previous quarters it was not material, so I didn't expect anything.
Yeah, I don't really see them benefiting. I mean, they just shut that wallet down that they developed, so I don't really see them being a beneficiary of the. I mean, who knows? I don't see it, but who knows?
Yeah, thanks, guys.
No, they're not really mentioning it in the quarterly report.
All right. Well, if we're GameStop out, if we want to talk about anything else, happy to. Keep this open until 6 o'clock for another 40 minutes. If anyone wants to ask any GameStop related questions, anything we didn't already touch on, also happy to do that. Yeah.
Maybe there's some more people that want to come up as a guest speaker. All questions allowed.
Yep.
So I guess here's another question then. What are your expectations for EPS this year, or well, for quarter four, and then we can figure out what the annual EPS is going to be.
I don't even have a 4Q view right now. Let me tell you, at least talk about what the consensus is. For 4Q, consensus sales is for 2.2 billion. There's only one analyst who has a 4Q EBITDA, and they have it marked at 85 million positive. You've got a few folks have EBIT at 80, and then EPS is at 23 cents. So
yeah, it would be a positive on the year then, if that were to happen. Marginally positive, like 4 or 5 cents or so on the year.
Yeah, I had 3 cents modeled in coming into the day. I haven't updated it yet, other than taking down CapEx again. But yeah, I mean that's what I have. But it's like what happens on we had the 9% drop on sales, so now full year sales, there's no way else to slice it, but it's going to be at least 2-3% down, I think, on the full year. It's like I guess the question I have is like, where do the sales declines get staunched, if at all? What does gross margin come to? I think gross margin will probably be, like we saw this quarter, strength in GM, strength in SG&A, but continued weakness in the top line.
Hello?
Hey.
Hey. This company is just really boring right now, and without the short thesis, I would just be in Tesla or something. I mean, and that's just a bet I'm willing to take at this point. I guess I'm a little bit happier that Ryan is going to do some type of investing on my behalf. That's kind of what people are saying, right?
I'm not following what you're asking.
Like
the change in the investment policy
right.
just gives him some more freedom to act, I think, using his own family office capital in conjunction with the company's capital.
Okay. So he can kind of dictate what happens to that cash that he has, that he's holding, as he feels fit, right? Even if it's
When you say the cash that he's holding, do you mean
GameStop.
GameStop Corporation's cash?
Right.
I mean, yes, he has control over the company's uses, for whether it's for M&A or whatever.
Okay. So that and the fact and the short thesis is the only reason why I even care about this company. I mean, it's great that it came back from bankruptcy. I think it's a great store, like for kids and things.
It never went bankrupt.
Well, no, I mean came back from the brink of bankruptcy. Sorry, but
it was never on the brink of bankruptcy.
Well, from just being like driven towards that direction.
It was priced as though it were going bankrupt.
Yeah, I mean,
I would agree with that.
Yeah. I guess that's the only thing I really have is, I mean, it's just so boring. I wish there was some cool product or something cool that was happening with it. But it's just like, he's cutting costs and he's doing the right thing from a business standpoint. I mean, you can't complain with that, but there's just, I just really got to think about what I'm going to do personally, because like I said, there's just other things that are just more exciting in the world.
If you're looking for short squeezes, this stock doesn't have very high short interest relative to a lot of stocks out there.
No, I mean, that's not the only thing I'm looking for. I mean, I have confidence in Ryan and his abilities, but it's just hard to see right now.
Okay. Thank you for sharing those thoughts there. Yeah. I think we probably run the well dry, unless anybody had any other GameStop stuff they wanted to talk about.
Well, we don't know anything, right? We don't know anything with the NFTs. We don't know anything with the...
We know they are immaterial to the business.
Well, nothing positive.
At least today.
So we're just kind of like at a dead end here, with just like an improving balance sheet.
Yes, I mean, I think your sentiments probably answer some of the kind of questions that were posed earlier about the notion of the direct registered share count, because I'm sure there are other people who share the kind of view that the shininess, there's nothing shiny occurring, therefore there might be shinier objects out there to look into.
Right.
So I get kind of that notion. But a few people are requesting, but it looks like it might be Bed Bath Trolls.
What's your opinion on the direct registered shares not just being the same for the last 3 quarters? Or do you have an opinion?
Well, actually, that haven't been the same for the last 3 quarters. I've been tracking the numbers. In quarter one this year, they were reported as 76.6 million, which was an increase of 600,000 shares compared to the quarter before. In quarter two, they reported 75.4 million, which was a decrease of 1.2 million compared to quarter one. And in quarter three, which is this quarter, they reported the same number. So it hasn't been the same for every quarter.
Well, not the same, but roughly. I mean,
but very similar.
not
Yeah.
changed.
So I guess if you look at it this way, yeah, the last 4 quarters there's been almost no change at all
Mm-hmm.
since quarter 4 2022.
What's your opinion on that?
I think anybody spending any time on that is misguided in what's important.
Well, then why would they even report
quite frankly?
I think. Well, actually, I don't really agree with you on that, Rod. I think it shows sentiment and how sentiment has changed with GameStop. So I think the explosive growth of the DRS that we saw in 2022 and the stagnation of this growth in 2023, I think is very telling.
Well, I guess I should have been more clear, because to me, sentiment's not relevant to the business, but I hear you, and you're right. It's a good proxy for retail speculator, investor, whatever you want to call it, sentiment.
Yeah, I mean, especially since it's not trading on just its fundamentals right now. So I think sentiment is important to take into account. Yeah.
I believe this business is not sexy right now. They continue to lose money from software. Ryan Cohen has to fix that. And if he can't fix that, it's going to
Can't
continue
really
to slow.
hear you, Equity. You got some other audio overcoming your mic. You want to try again? Also, Dylan came up.
Somebody DM me a question.
Okay.
I can read it out loud. There's a section in the quarterly report that discusses IMX and the results of meeting those milestones. What do we think of that?
Last I had
The
seen,
entities are dead.
they have different.
There's no focus on the marketplace anymore. There is no focus. The focus is all on the core business. Right, so on the IMX, anything like that, that's not a priority.
Right. Yeah, I hear you. I think this is just old news as well, right? It has to do with the milestones and then meeting the milestones.
Exactly. That's what I was going to say. The last disclosure was that they had said they don't intend on meeting any more of the milestones. So even though they have, a couple items just chilling, it's irrelevant. And as they note, revenues from digital asset wallet and NFT were not material for both the 3 and 9 months. So I would agree with the notion that it's completely backburnered, completely irrelevant. Don't expect anything from them.
What could they do, though, to reverse software going down, right? Because that's the biggest piece right now. Digital is here. No one is going to be buying CDs anymore. That's a big issue for them to solve.
I couldn't hear you with the LIRR behind you. Could you say that again?
Yeah, I think the biggest issue for them to solve is software. And that's the key piece, and Ryan Cohen himself probably doesn't know how to solve it. And tomorrow will be interesting to see.
I think what I made out of what you just said was you're thinking the biggest problem is software, and you're not sure if Ryan Cohen knows how to solve it.
it's not
Exactly.
something that can be solved by, it doesn't matter how good you are at a business. When you face a structural headwind,
The
like,
demand is gone, and it's
yeah,
not coming back. So what are they going to do to replace that?
yeah.
And it should be interesting tomorrow to see if they go out in the open market and they buy the shares, Larry or the other guy on the board.
Yeah, that's true. But so far, the purchases that we've seen have not been that big. Personally,
As a
in
percent of
my
their net
opinion,
worth,
it's
immaterial.
from my perspective, they were token buys. Yeah, like you said, not really material if you look at the person's net worth.
If you're a billionaire and you buy $10 million of something, it's just immaterial. I'm not saying it's bad. It's good, but just I think sometimes people, like, I was surprised last time there were some insider buys how much the stock reacted. It's like, people, these are nice to see. I think if you are positioned long and you want to continue to see them occur, but it's not. It doesn't change the fundamental story.
Yeah, but it could instill confidence, right? If they continue to buy,
That's
they
true.
believe something is on the horizon. Versus if they just give up, then this thing's going to zero. I don't know.
Well, or
We'll see what
$4.
happens. Yeah, or $4.
I think there's always going to be some premium for Ryan Cohen. So while Ryan Cohen is running the business, but the question is, like, how much premium, right? And I think over time we've seen this premium decline. Like in 2021, the hype and the speculation was insane, really. And it's nowhere near that level anymore. I don't think it will ever get back to that kind of level.
Well, let's remember too, as we've observed from some of the questions some of the folks have opted to ask, there's plenty of people whose reason for being interested had nothing to do with the underlying business at GameStop. It was a perception that there was a prospect of getting rich quickly. So I think that's why you've got, like, different people at different phases in their, I guess, journey through identifying what it is that they're buying and why. A lot of new entrants came into the market, and thought that stocks only go up, right? And some people benefited from that significantly in 2020, 2021. But yeah, I mean, that's why we've tried to focus the discussion on the actual things we can observe the business. And the reality is the headline, or that the top line challenges have not diminished. If anything, they've grown. And while they can improve gross margin, they can improve selling cost and overhead cost, there's only so much you can do if that top line number is going to keep whittling away. And where does that change? And I think that's where it could be years. Maybe it doesn't even happen in 24, a transaction. But I do think, and having spoken to him once and having observed him throughout the whole saga, I think it's safe to say that Mr. Cohen is very serious about the fact that he is the largest investor at GameStop. He's aligned with the long-term interests. He wants to see a positive return, probably, but there's absolutely no guarantee of that. And he made it pretty clear that it's survival mode. That survival is very different than thriving. And the business, as I keep kind of coming back to, is priced as though it's going to be thriving in very short order.
Well, I would add one point though. Ryan Cohen does not need the business to thrive. I think if I remember correctly, his cost basis is below the cash on hand per share. So even if it falls to like zero premium for his execution, like he could still like take the company private, like just get rid of the like just liquidate the business and get the cash out, and he would still be in profit, right? So even if things go seriously south, which I don't think is going to happen. But like, even if it were to happen, then he would still be in profit.
Yeah, I don't see him doing that. And ultimately, his probably final goal is to issue dividends and then collect those dividends.
Yeah,
He's a profitable business for that.
He doesn't strike me as a dividend investor based on what he talked about at Alibaba. I think he'd probably lean toward, if you don't have internal uses to reinvest the cash, I would think he'd lean more toward buyback depending on valuation. But I also don't think any sort of dividends coming from this company anytime soon. As somebody who's received many a dividend from GameStop preceding them cutting it to zero in 2019.
What kind of transactions do you think he'll be investing in now that he's the chief investment officer as well? What do we see?
You talked about that a little bit earlier. I think it's going to be just whatever opportunities the market presents, like with what the company now known as Beyond did, right? They were overstocked. They were able to completely change the name of their business and kind of their marketing by buying IP out of a bankruptcy on the cheap. So I think that credit markets are expecting more defaults next year. There's probably going to be more distress next year in credit markets. Will there be interesting restructuring opportunities that are in, maybe it's in an adjacent retailer and he sees synergies there? We could speculate all day. But my main speculation would be that it would be a distressed transaction. I don't think he's going to go pay list price for something. If anyone has any other thoughts, please feel free.
I mean, if he
we've
wants to,
we've talked about the authentication piece and potentially with grading cards and the like is another adjacent thing too. Sorry.
I would say if he wants to make an acquisition, like the best time to do it is in a high rate environment, as it suppresses valuations. And we don't know for how long this high rate environment is going to be like this. That's another topic of debate outside the scope of this space.
Your crystal ball doesn't have the answer on that, Tim?
No, it doesn't. I wish it did.
I would agree with that notion, though, that
would be so much easier.
Rates depress valuations. The other thing that depresses valuations is being a forced seller. So I tend to think he's going to prefer to be a buyer from a forced seller, rather than try to make something happen. I don't think he feels a huge sense of urgency to make a deal just because of this incremental power he has. To me, it's more about just positioning to be able to strike when the iron is hot, which I think it's only going to get hotter.
Can y'all hear me? Okay, sweet.
Yes.
I kind of wanted to address the guy that hopped on, I don't know, probably like 5-10 minutes ago, saying that this is boring and he doesn't know why he's here. And what I'm going to say to that is kind of like the way you build a business and the way you do things responsibly is admittedly kind of boring, but this is very much a brick by brick thing. I mean, I think, a lot of the get rich quick crowd has either moved on or kind of come to terms with the fact that this isn't going to be an overnight thing. This is very much a brick by brick operation. And I think in terms of like the NFT pivot, I don't think GameStop is necessarily in a position to take on tremendous risk in a wholly unregulated industry such as that. And the problem with America is that innovation often precedes legislation. And if there's no legislation backing any move into that sphere, then they'd be opening themselves up to risk. So I think it's important to keep an open mind and kind of move with how things are going to have to move in order for things to be done responsibly at GameStop. At least that's my opinion on it. That's the lens through which I've been viewing this. I'm curious to see if you guys agree or what your thoughts are on that, but I felt like that's something that needed to be said.
Yeah, I agree. This business is boring. I mean, and that's usually how it is. There's no super high growth. They're losing market share, and he's got to fix that. Now you got to ask yourself why you're invested.
Yeah, I mean, I don't like I I don't want it to sound like shilly saying it's boring, but I mean like retail business isn't it's not a Tesla, you know? It's not on the forefront of innovation, and to be on the forefront of innovation in gaming, I think involves Web3 gaming, but it takes a lot to build up the infrastructure to support that. A lot of work from developers, people on GameStop's side, a lot for consumers to adapt to. Like there's a lot of moving parts that go into making that work, and I think you just have to understand that that's something that would take a significant amount of time invested to make a product.
And Willem, I would say from observing people's sentiment and lines of thinking in the GME DD server, at least, a lot of folks who are bullish on crypto and Web3 and the like have soured on GME, at least. You know, as you noted, everyone has their own different reasons for investing, but I guess in line with kind of what you're saying, yeah, I don't think if I were a hardcore Web3, gaming bull, I don't see why I would be choosing GameStop as kind of the target of my investment dollars. Based on at least where things stand today and what's transpired over the last few years. Like they clearly tried to get some exposure, and as you noted, there's a lot of regulatory uncertainty, and I don't think they are interested in being the one to bear that risk. So maybe they'll be a fast follower, but if I were trying to be invested in like startup Web3 related stuff and at the cutting edge, yeah, I think the reasons to be investing in GameStop for that have
Yeah,
diminished.
I completely agree. I mean, I just don't think I don't think they're in a position to take the risk to be on the bleeding edge of that. But like you said, a quick follow up. I mean, they're a legacy brand with a big name, and once kind of the unknown waters have been traversed and mapped out, then I totally see a phenomenal opportunity for them.
Yeah, fast follower strategy would work for them,
Exactly.
I think, with the brand and yeah.
100%. So I don't know. I just wanted to kind of get on and say like it probably is going to be boring for a little while, but I still I mean the my thesis hasn't changed. Maybe the short squeeze thing is kind of um, fizzled out a little bit, but I mean I'm not sure. It's all speculation. Um, so yeah. I do want to hear like a DRS versus no DRS kind of debate because I haven't heard much about it. I mean, Super Stonk is an echo chamber of all DRS, and I'm a little bit weary of that, but I have DRS shares, and so I'm curious about pros and cons.
I'm curious to know why everyone decided to go towards that route. If you guys don't mind sharing.
Go towards what route?
DRS.
I don't know about everyone. I thought it was a silly thing from day one, and I'll say why. You're forsaking real optionality. Optionality has real value. You're not getting anything for doing it. I'm personally also a-okay with lending my shares out and generating income on my shares. You're forsaking that as well as the ability to write options. So for me, that's a non-starter to give that up with nothing in return other than I can feel good about myself and my internet friends talking about it.
Because I would say I'm probably in the same boat. I would say when DRS started coming through the different, let's say, communities in Reddit, Superstock. I can't remember the super that was there prior. But it seemed like when people were pushing DRS, another main message was do not play options. And to me, because I trade a lot, and that was what destroyed the, you know, why I like GME to begin with.
I mean, I think the anti-option sentiment that I've kind of seen is because there's relatively compelling DD around it benefiting market makers. I mean, it I don't know. I'm not well spoken enough and well read enough on the matter to dig into it, but I have read DDs that have made a pretty compelling argument that it empowers market makers. And I mean, market maker bad has kind of been the prevailing sentiment here, and I do pretty much agree with it, especially if you're a retail trader playing options, because it is almost always going to be through Citadel or if not them, then Virtu.
Right, but it doesn't mean that you can't, you know, make money at the same time. And I think, if we look at it realistically, we're all here to better our lives. Money is important. And I think just the fact that we're taking out the liquidity in DRS where we really can't do much to it, in my opinion, makes it a lot easier to manipulate. And then also with options, I think what they were trying to sell the communities was that it further enhances the ability for institutions, to recycle those shares even more so. But I thought of GME as almost like Tesla 2.0. So if you take into the context of what SoftBank did, which got them banned, trying to manipulate and create gamma squeezes, that reminds me a lot of when the sneeze happened. Because I remember it was like 14, the change had filled up. Then it was 64, it filled up. The next Monday, Tuesday, they raised it to 110. And then to me, that's really what drove the squeeze to begin with.
Yeah, I mean, I think there's pretty compelling data saying that the sneeze was basically just a gamma squeeze. I mean, correct me if I'm wrong, but that's what I've read, and I kind of subscribe to that belief. I do think, I mean, yes, it's a good argument in terms of, all right, it's becoming more liquid because of DRS, sure, and it is making it more volatile both on the upside and the downside. And like that's completely valid. That makes sense to me, logically speaking, in terms of how capital markets work. I get that, but I think the kind of like the goal with the DRS movement is to kind of pull the tide out and see who's swimming naked. Like if you make something so illiquid, or lock the float, so to speak, like
The other lens is that people are trying to effectuate an illegal market corner. And I know people like to use the word we, but as someone who's dealt with SEC, what a lot of these people are proposing is illegal and market manipulation. So I just would always warn people to be cautious about what you say, even if you're an anonymous account, because the SEC can and will find you.
Not
that,
we is
not that
we is colluding. We is if I am ever on Reddit or saying something, I avoid we, and if people say it, I caution against it. But I do think that there is, like, fundamentally the way capital markets work, if DRS is achieving or is able to achieve what people are trying to achieve with it, it could kind of appeal more to that get rich quick crowd in terms of tremendous upward volatility. And I think that's kind of a lot of the reason why people are pushing it. And it does make sense to me. I don't know about you guys. I'm curious to hear your 2 cents.
Well, I mean, this is just theoretically speaking, but it's a multi-billion-dollar company. It's kind of hard to get retail to all buy one stock and hold it into a particular location. So, yeah.
And remember, this does nothing to increase the intrinsic value of the firm. So
yeah, again, well, it can give them cash, like kind of like how they were able to, position and bolster their balance sheet after January.
Well, then each share that you own has a smaller claim on the remaining business, so it's not accretive to you as an individual shareholder. It could be accretive to the firm to sell,
right? But it gives them ammo to
above
pivot.
Intrinsic value.
I mean, they need ammo.
Don't want to see that. You don't want to see that as a shareholder. What we want is business fundamentals. What the shareholder should want is business fundamentals to improve. They have improved versus last year, but there's still a long, long, long way to go to see any sort of shareholder value creation. And that's
a very succinct. I agree with that.
DRS, non-DRS, that doesn't matter. Ultimately, what matters is you need to show profit for institutional investors to buy your stock, which will increase the value of the stock.
Right, and to build on that thought, because I agree with equity, all that matters is, at the end of the day, in the long run, all that matters, which the long run is a longer time than most people care about. the fundamentals. And the things they've taken some actions, they've taken several that that you don't see in the queue, but if you follow things like on Reddit, especially the employee subreddit, I find very informative. They've made tweaks to the warranty policy, for example, where they're going to be giving away fewer new devices when they do warranty replacements. Now, will they thus see declines in take rates on the gameplay guarantee or the PRPs, whatever? Like, those are other questions and how you try to model the take rates on warranty. I mean, warranty is almost pure margin. That's why we talk about in-store versus web sales. They've got a much higher take rate on warranty upsells in-store than they do online. So like those are the things that will matter. And I do worry how lightly they're staffing some of these stores. I see, you try not to overweight any one particular comment, but I've definitely seen an uptick in comments about like how few hours some of these employees, some of these stores have to staff. And having walked in a couple stores and seen, if there's a longer line, I'm less likely as a consumer to wait in it. So, you've got to find that fine balance of cutting costs, but also not cutting the customer experience.
I wanted to segue into e-commerce as well. If you pay attention to like Instagram, Twitter, as well as subreddits, there's been a lot of complaints about buying a new game and being shipped a used game.
Yeah,
so I did
a
a
gutted
little bit
copy.
yes, I did a little bit of digging, right, for the ones that they posted, like Sonic, for example. The new copy would be, let's say, $30. Used copy, $54. Right. So in my mind, I'm like, okay, there's no reason for that. And what I believe that they still haven't fixed is that they just switched up the barcodes as well as what they've written on it. So a used copy will show as new. It gets shipped out as new at that the used price. Whereas when you select used, you get the new copy with with all the booklets and etc. for the normal price. And I think that's been going on for 3 months or so now. And there's still a lot of different deficiencies, I would say, just not even including the in-store experience, but online. And it's also
Yep.
very difficult to query. So I don't know what Cohen has brought over from Amazon, but it seems like the last 2 years is pretty stagnant.
Portad, that
I don't
sentiment
know.
is definitely shared across the GME DD server generally. The perception that the incremental e-commerce enhancements over the last couple of years have lagged, but it, people, I guess, feel like it should be at this stage. Because I agree, as somebody who uses the site, there's still a lot that goes wrong when using it, and it's been unimpressive, I guess, given the quantity of people they brought over, the organizations of the caliber they took over. So just my
But
thoughts.
let's not be all doom and gloom here, right? Because they have made a lot of changes on the website.
They have, but I would say one of the main culprits is when they signed a deal D365. I'm in that tech space, so I implement that. I do customizations at a large tech company, and I would say with 100% confidence that Dynamics 365 is the most trash system I've ever used.
Why?
Everything is limited, so inputs, outputs, limited. If you compare, let's just talk about CRM. Very limited compared to Salesforce, very little customization. And all of the training sessions that I made my dev team go to has not really given them anything as an advantage. So, for example, all of my records that need to be calculated and pushed into my company, I've had to create separate processes and engines outside and then have it incrementally pushed back into the CRM and then eventually integrate it back to the ERP system, which is not ideal.
Right.
Hey, just to like 5-10 minute warning, FYI. We'll wrap if we go a little past 6. But I know Tendy Baron, thank you again for joining. Everyone else, Chris, Eric, Equity, Pordad, Joe, and the folks who were on earlier, appreciate hearing a lot of different people's perspectives. Obviously, a lot of people remain very interested in the stock. I remain just fascinated watching it, and I hopefully people enjoyed the discussion this afternoon. We're just trying to talk about what we can observe and hear different people's perspectives. One thought I'll share, the talk about ERP. Back in 2020, October 2020, there had been the announcement that the company was going to implement Microsoft devices and kind of Microsoft Cloud and all Microsoft into their, I guess, back end. That was with the prior management team. But the interesting thing was that agreement had purportedly included GameStop earning incremental revenues on the sales of downloads from consoles that they sell. So if they sell an Xbox Series X and somebody buys something through the console, that they would get a mix of, very small, presumably, mix of those sales. I have to think that never came to fruition, since they now went with SAP for their ERP, and that Microsoft deal got ripped up. But that was something that could have been interesting, and that we tried to model out back then. But it doesn't look like it's transpiring, because the results, you can't see it in the results, at least.
Yeah, and I just want to add to remove the doom and gloom. There is a huge community on Blind on Facebook messengers internally. There are a lot of silent folks that are still holding a lot of GME. They just don't talk. So there's a lot of us out there.
I will say one thing with that. I would say that statement probably rings true. Is I've been fascinated by, and I didn't write any when it got down to 12, but when the stock does sell off a lot, I mean, the truth is there's not much liquidity risk from the business perspective. So, like, if you want to write $4 or $5 strike put options on high volatility sell-offs, you can get it. I think a fairly deep. I mean, look, you're bearing risk. Obviously, anytime you write a put, things can always go bad, and equity can always go lower than you think. But at least for GameStop, when vol is rich, and I wish I'd done more of this, go back to Jan 21, but writing some of those out of the money puts can be another way just to play the security, right? You could write the January 25, so a little bit over a year. The mid, at least going into the close, there's around 50 cents, right? So the stock's trading at 14.50ish after hours. It's got about $4, a little less than $4 per share in net cash. So you write the Jan 25 $5 put, you get 50-cent premium. It's actually a pretty solid rate of return on your investment, even if you fully back it by the $4.50 in net cash outlay. To get that over around, let's call it 10% annualized return on what's 70% out of the money put, right? So again, not recommending any strategy. I just find writing volatility, especially going into an earnings day like today. I don't know if anyone watches the daily vol, but usually it spikes in the last half hour of trading. So I mentioned earlier, I wrote some of those short strangles right before the close, and whether you're investing in it or trading it, I think there are various ways you can try to profit off of this security. But
I got a question.
I think that's one that might be interesting to people.
Hey, Joe. When can we expect part 2 in Ryan Cohen?
Look, if it happens, it happens. I'm not currently pushing for it, but who knows?
Did he reach out to you last time?
Last time, yes, it was Cohen reaching out to me, have a conversation, proposed the idea of conducting his first interview with a publication like ours versus the mainstream media. We followed up, agreed to do it, and yeah, it took some time to come out, but happy with the result. If he wants to have another conversation, I happily would.
Did he screen the questions beforehand, or no screening?
We did agree upon different topics, but the questions were written by me.
Got it. Thanks.
All right. Well, top of
Yeah,
the
with
hour,
that,
Joe.
it's now top of
So
the hour. I'm saying the same thing as you, Rod. If you want, I'm gonna just go ahead and give some programming notes, and then we can wrap
yeah,
it.
please.
Cool, everyone. All right, yeah. So we host these calls every Wednesday. This week a little different because of the GameStop earnings call, but typically we do an open mic, and that's at 7 p.m. Eastern, 4 p.m. California time. So if you're not following at GMEDD, you can tune into the open mics there. We talk about any and all stocks. Great discussion. Typically, got a good group of contributors, and always manage to learn something. So tune into that. And then on Fridays at the close, we host the Wook and Review, where we recap everything that happened over the week. So with that, thanks everyone for tuning into this GME discussion. Hope to talk more GameStop in the future. There's a few tweets out on at GMEDD recapping the earnings as well as noteworthy things from the 10Q. So check those out as well. But with that, that's all I got. Rod, anything to say? If not, feel free to close it.
No, thanks, Joe. Thanks, everybody, for joining and tuning in. Hope to talk with some of you soon. And stay safe out there, everybody. Have a good evening.
Take care, everybody.